Joining me now, Solis Alternative Asset Management Strategist Dan Greenhouse and Mainstay Capital CEO David Kudla. David, let me start with you on NVIDIA. What are you looking for today?
Good afternoon, Taylor. Well, I think everybody is looking for a blowout on earnings. We've seen, 14 out of the last 16 quarters, they beat on earnings. But, with the whisper numbers, we really need to see something big. We want to see revenue beat. We want to see earnings beat and beat by a wide margin. That's what we expect. With the weight of the world economy and the world stock markets on NVIDIA's shoulders, that's what we all hope as investors that we do see in this announcement in about an hour.
Dan, you can't always do individual stocks, but Dan Ives over at Wedbush said that this is the new oil and gold in our new economy. Do you sort of agree with that sentiment, the impact that NVIDIA has on the broader market?
Yeah, listen, I find it often difficult to argue with Dan Ives. He's generally right about these sorts of things, and I think that he's probably right in that description of today. I would just push back on the idea that the entire global economy is hinging on this earnings report. I don't know whether David's being a little hyperbolic here, but listen, certainly the market is dependent on the AI trade. It's not just the semiconductor stocks. It's a lot of the infrastructure stocks. It's the HVAC stocks. It's some of the power companies. So there's a broad trade throughout the market here that has NVIDIA at its core for sure. But at the same time, I wouldn't go so far as to say the global economy is poised to fail for some reason if NVIDIA reports only $29 billion in revenue instead of $30 billion.
David, are you getting...
And Dan, I was being hyperbolic for sure. It's a bellwether stock for AI. We can all agree on that, and because we know how instrumental it is in that technology that's going to be transformative. It's going to usher in the next industrial revolution. It's not like EVs that a lot of hype and now they've gone flat. This is real, and it's going to be meaningful.
Dan, where are we in terms of sort of this pullback that we've seen from record highs, right? It was just yesterday we were sitting here less than 1% from record highs on the S&P 500, slipping a little bit today, but still, relatively close. But there seems to be like we're sort of in this waiting period. I don't know if it's Fed rate cuts. I don't know if it's NVIDIA, but sort of this quietness underneath the surface. What is sort of that next catalyst to push us forward?
Yeah, I mean, listen, the answer is the next two important economic reports, which is going to be the CPI, which is before the Fed meeting, and the jobs report, which is before the Fed meeting. And that'll tell us or help inform whether or not the Fed, from the market standpoint, cuts by 25 or 50 basis points. And to be clear, the market at this point is assured of a rate cut or believes it's assured in the rate cut. The only question is by how much. And those two reports become the important ones to watch for presumably determining how large that cut's going to be.
David, do you agree?
Yeah, I agree that they've signaled, right? Jay Powell signaled at Jackson Hole that it's time for an adjustment in policy, and that means easing. It will start in September. We're going to be back and forth based on the economic data, whether it's 25 or 50. I think they will start with 25 just for symbolism, just for the sake that there's no indication or anyone takes away from it that they're behind the curve, that they should have cut 25 in July. So I think we'll start with 25, but wouldn't be surprised if we see 50 in another cut before the end of the year.
Let me just, I would be surprised if we got 50. I know, obviously, as we just showed on the screen, there's about a 33% or 1 in 3% chance, 33% chance of 50 basis points. I would be surprised. I'm one of these people, clearly I think the Fed is offsides, for lack of a better word, in terms of where the Fed funds rate is relative to where it should be is probably a little too wide. But the idea that they need to cut right out of the gate by 50 basis points, implying they're way further offsides than they should be, I just don't see that in either the economic data or the inflation data. The economy is still doing quite well. Job losses are low. Yes, the unemployment rate is ticking up. And I don't think David suggested this at all. But just for the viewer at home, there is a legitimate debate about whether they should cut at all. Again, I think they're probably going to do 25 basis points, and justifiably so. But I just don't see any reason for a 50 basis point cut at the next meeting.
David, I want you to weigh in here in the final time that we have left. Given your outlook on a recession or not, rate cuts or not, where is the right place to be in these markets, keeping AI and NVIDIA aside? What do you like? What gets you excited?
Okay. And just to clarify, Dan, that on that first cut, I'm with you on 25 versus 50. It'll depend on the data as what happens later in the year. But what this is, what we have going on right now is an economy that is still chugging along. We've got inflation that's on a glide path. to the Fed's target. And if they do engineer that soft landing, we can start to broaden out and make a caps that were so strong for so long and look at small caps, look at value. For investors that haven't extended bond duration yet, have been in money market or ultra short maturity, this is the time to be doing it because we are going to see the Fed funds rate come down and interest rates come down overall.
My first love is the bond market. So we're going to leave it there on a high note.
I thought you were going to say David. I didn't know where this was going.
The bond market. So we're going to leave it there. Dan Greenhouse and David Kula, thank you so much for joining me. Really appreciate it.